2013 saw a new wave of investors coming into the resi investment market. A lot of these players are looking at longer term investment opportunities, but 2013 particularly saw some significant milestones in terms of transactions. This started with the likes of APG and Granger and a transaction of an existing portfolio, moving on to M&G and a Barclay transaction, and then more recently we've seen the likes of Place for People acquiring assets from Terrace Hill and Urban Splash. Since then we've gone on to see some more development focused opportunities where longer term investors, which are the new breed, and the pension funds maximising their opportunities and coming into this sector. The change really has been around longer term investment and income producing assets, and this is really the new wave and the new style of investment that's coming to the market. The current PRS sector, the private rented sector, is quite fragmented. Whilst it's large, not a lot of the assets sit within institutional hands. This actually is a problem for institutions looking to gain exposure to the residential sector. And what we've seen is an initial grab of assets, and certainly the deal flows over 2013 have peaked and potentially could fall away, subject to any further portfolios coming to the market. What we've now seen is in fact more investors looking at development opportunities as a result of this lack of opportunity of standing stock. So a big focus has moved from existing assets to development, and that's where we see the volumes coming through, and those are really where the opportunities for the longer term investors who can create distinct portfolios of PRS stock for the longer term. I don't necessarily think there's a funding gap in the residential investment market. There's a significant amount of equity available. A lot of this equity, the new equity, is not necessarily reliant on debt. Some of the more institutional funds may be reliant on debt to a degree, but not necessarily. I think that the issue is more about a viability gap in terms of development, and looking at the way that PRS feeds into a residual around land value, that is the essential bit that we need to crack. But I think if you look at certain locations where the rent is strong in compared to values, or the size of the site is sufficiently large that a PRS output could run alongside traditional development sales, those are the opportunities where investors will be able to close the gap and make PRS viable in those scenarios. In terms of outside London investing in PRS, I don't necessarily see that we're quite there yet. I think that there are arguments for other regional centres outside of London, but we have to understand where we are in the emergence of this sector. A lot of focus has been on London initially and the South East, which is common sense because that's where a lot of things start in the UK. I think it will take some time for investors to get comfortable with locations outside of London, but we're actually now seeing that happening now in development, and certainly Birmingham, Manchester, Leeds, there are now a lot of projects which are coming forward, and even in the North East and North West where PRS can actually make sense as part of a wider development proposition.